Welcome to the weekly review of the markets for week ending February 15th, 2019 from Hernandez Retirement Services. This is Agustin Hernandez. Before we begin, the opinions voiced in this material are for general information only. All performance reference is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Technical analysis is forecasting of future financial price movements based on an examination of past price movements and cannot predict the future. Technical charts referenced are subjective. No strategy can ensure success or protect against loss. Investing involves risk, including loss of principal. On this week's agenda, with the S&P gaining over 2% last week, has the index confirmed a new bullish rally. I will review other parts of the U.S. stock market, mid-cap growth, info technology, aerospace, defense, and banking. Is the Brazilian Bovespa pullback over? Is the developed international markets in a bullish or bearish pattern? With the stock market strong rally, is the 10-year U.S. Treasury note bullish run over? Finally, we end with what does it mean? After a 2.5% gain last week, where does the S&P stand? Well, looking at the moving averages, price finally did get above and stay above its 200-day moving average. And its 50-day moving average is beginning to flatten out. But it will need this moving average to turn up and cross above its 200-day. For now, based on the moving averages, the S&P is still in a bearish pattern. Now I understand the recovery rally seems so strong, but if we can follow the red line, we can see that the S&P has yet to fully get back to its 2018 high price. It has dug itself a deep ditch. It has climbed some with the help from the Fed, but it has yet to get to close the deal. Can it continue this rally? Or will it need another breather before another leg up? It may take several weeks to get an answer. In this slide, we have the Russell Mid-Cap Growth Index. Like the S&P, Mid-Cap Growth Index suffered and fell hard towards the end of 2018. But there are some good signs. We can see that price has broken through its 200-day moving average. It was below this long-term trend line since October. So judging by price, it seems to be in a stronger position than the S&P. Now, let's look at its 50-day moving average. Here, we also can see a rising 50-day moving average. That is also a strong positive sign for this index. This 50-day had been falling from mid-October to mid-January. How long will it take the 50-day to cross above its 200-day? Will it beat the S&P to it? For now, it is on the right course, but not there yet. Now, let's take a look at sectors in the U.S. stock market. I start the sector overview with the NYSE Information Technology Index. Now this index, unlike the S&P and mid-cap growth, did not take a staircase downward slope. As we can see, it just sliced its way down and began to bottom out in late October. It just sputtered around the bottom of the chart until early January. Like the other major stock indices, it has recovered a bit from the bottom. It has had a pullback already in 2019, and that pullback occurred above its 200-day moving average. It survived and stayed above it and has begun another attempt to rally higher. If we look at the 50-day moving average, it is rising and it is close to a golden cross. This sector looks strong and promising. It is not there just yet, but we are close. Now let's look at another sector. This chart, we look at the S&P Aerospace and Defense Index. Now this index looks like the mid-cap growth index. It had a staircase fall from October until late December and has since rallied sharply. Its 200-day has flattened out and its 50-day moving average is rising. While not as strong as the infotech sector, it is showing more strength than the S&P 500. Now, it still has not fully recovered from its highs in late September, but it is trending well. But we are at least close to a month before we can see the 50-day crossing over the 200-day. Now, let's check at the banking sector. The S&P banking sector has not had the success as the other indices we've covered. The index peaked in August and began a slow downtrend before the big drop in December. It has rallied since, but price has not gone above its 200-day moving average. In fact, the long-term trend line is still falling. And the 50-day is also falling, which is not a good sign as momentum seems to have stalled out a couple of weeks ago. This sector has recovered a bit, but not as strong as the two others we looked at. Now, this is normal in any market environment, as not all sectors participate in rallies. Will this sector be the laggard of the U.S. stock market, or will it find some strength and catch up with the other sectors? Speaking of an index being in strength, let's look at Brazil. A week after the Bovespa lost 2.5%, it rebounded with a gain of 2.29% last week. Now, unlike the U.S. equity markets and sectors, this emerging economy has been in strength since late 2018. It has pulled back and rallied several times. Despite its pullback, its 50-day moving average is still trending up. And now its 200-day line is beginning the process of sloping up. It is very early in a bullish pattern, so I would like to see it break above its high of 98.6. But as of last Friday, this index is looking strong. Are other parts of the globe following suit? Here we go to the Morgan Stanley EAFE Developed International Stock Market Index. Here we see a falling world index. Yes, it has had a rebound, but there is nothing to be too excited about. From July until September, it tried to rally but failed to get above its 200-day moving average. After those failures, price dropped from September until late December. Its 200-day moving average is still falling, but at a minimum, its 50-day moving average is beginning to flatten out. Now, can this global stock index begin to gain strength, or will it fail like it did in September and drop back down? Unlike the S&P, this index is still hurting. It has more work to do before I can consider it ready for a breakout. And with all this talk about stocks, what is the 10-year U.S. government note doing? Here we see the 10-year U.S. Treasury note. It lost 0.33% last week, but it still has held above its rising 50-day moving average. And another positive sign is that its 200-day moving average is sloping up. Those two moving averages put this index in a bullish pattern, but price is beginning to show weakness. The last three peak prices have been lower, while the last two lows are lower. Now the US note could be just experiencing short-term weakness, and in the next couple of weeks it can recover and break above. But for now, it is a glass half full situation. It is still very early in a bullish pattern, so let's see if it can survive, or will it go down with the strength of the S&P. What does this mean? The US stock market has rallied off the lows of 2018, and it has been impressive. But it did dig itself a big ditch that it has not fully climbed out of yet. Now there are some real encouraging signs as we see that mid-cap growth is trading better than the S&P, and when sectors such as infotech and aerospace defense are pushing strong to get into bullish patterns. Yet, none of these, as of now, have broken into a bull rally. The US stock market is still in a counter trend rally. We are close, but no cigar yet. The next several weeks should be interesting. The reason I have put the Brazilian stock market in my videos is because it is one of the few countries' stock markets that are in a bullish pattern. The US stock markets are not there yet, and neither are the developed international markets. Finally, the US 10-year note has stalled. With the US equity market starting 2019 strong, this index has faced headwinds. But as of now, it is still in an early bullish pattern. Can it hold? The US stock market results may decide this. I would like to thank you for viewing this video, and I hope it was helpful. Please like and subscribe to my channel for future videos.